At noon, the recent blow-ups of some big-name IPOs, leading some to question the way companies go public in the future. According to sources today out in San Francisco, several of the Valley's leading venture capital firms are gathering at the Palace Hotel with around 100 private companies to address that very issue. I'm told by sources that Benchmark's Bill Gurley helping to organize that event, and that other VCs in attendance include Andreessen Horowitz, Kleiner Perkins, Sequoia Capital, Menlo Partners, and Altimeter Capital. Several hundred people expected to attend, along with the New York Stock Exchange's president, Stacey Cunningham. She'll be interviewed on stage. Direct listings versus IPOs, key on that agenda. The topic gathering steam after this comment from Benchmark's Bill Gurley on the halftime report 2 weeks ago.
I think Silicon Valley's been on the bad end of a bad joke for about 4 decades now in terms of the way the traditional IPO process works. Over 39 years, that's been $171 billion for Silicon Valley companies, and it's been increasing lately. Just year to date, we're at $6 billion in underpricing.
Well, joining us now is our Silicon Valley reporter, Deirdre Boser. So Deirdre, Gurley's trying to do something about it. I'm wondering whether you think it's going to, have lasting staying power. It seems to be a groundswell developing now.
Right. Well, I think we've been talking about it for a long time, Scott, about how this IPO model is broken. These companies pay between 3.5% to 7% in fees to the investment bank, and then you see this first day pop, which could have gone to the company. So it's interesting when you look at a recent IPO that was deemed a disaster. Everywhere, Smell Direct Club, right? And you saw that share price come down the first day. Some of the VCs here, they don't think that that was such a disaster because the money ended up in that company's pockets. There was no pop that went to the investors. It went to the company. So I think this direct listing model, and what they're going to be talking about today at the Palace Hotel, which is just a few blocks from here, is how direct listings give these startups more flexibility and more leverage when it comes to the investment banks.
Yeah, I mentioned you were going to have about 100 of these privates in attendance at that conference. I'm wondering, how you think some of these late-stage private companies are going to be thinking about all this going public, going in the future, and whether you think they're going to be swayed by the argument that Gurley and some of these other VCs are going to make today.
Right. Well, a direct listing doesn't work for every company, right? You have Spotify and you have Slack that had enough money on their balance sheets. And what's so interesting about them, it's Slack in particular, it raised so much money in the private markets because private markets are flush with cash. You've got the Vision Fund, you've got companies raising hundreds of millions of dollars, and some of the institutional investors investing in that stage. So they were able to, their businesses were better understood by the public too. But you think about some of the other companies that aren't as well understood, the Cloudflares, the Datadog, some of the others. Could they do this model? That's unclear. But I think what's turning out, you can do a direct listing and then raise money a week later and avoid the roadshow and some of those enormous fees. So there's an argument to be made, and that's what you're going to hear, I think, at the Palace Hotel today from these VCs, that there is a different way of doing things. You don't need to do a traditional IPO, which we've been moving away from anyways. You can do a direct listing and sort of choose the aspects of a traditional IPO that you'd like to bring in. And it's a pretty good argument for a lot of these companies. You have a big name like Airbnb that's looking at going public next year. They've got enough cash on their balance sheets. They simply need a way for their employees to cash out, and some of their early investors. I think it could be appealing for a number of companies that I speak to here.
Glad you mentioned that. Stay with me. Let's welcome in a venture capitalist who is invested in Airbnb. Rick Heitzman of Firstmark joins us from New York City. Rick, welcome. It's good to have you on.
Hey, Scott, good to see you again.
Direct listings the way to go?
I think it's more and more so becoming the way to go as companies are more profitable and they have a greater path to profitability in the current world. And the discount that companies have taken on the IPO is just too much. So banker fees aside, I think that discount's better off in the employees and founders and shareholders' hands.
Would you advise Airbnb, which you are an investor in, and Deirdre was just speaking about it, would you advise them to do a direct listing instead of an IPO?
I think there's still an active conversation there, but Airbnb has a lot of the criteria that you look for in a direct listing. It has a great brand, so people know about the company. It's profitable, so it doesn't need the capital, and there's no financing risk. It's a big enough company that it will be able to draw research coverage regardless. and there's been enough float and enough secondary trading, so there's a price discovery out there, so you have a pretty good sense of what the company's value is going to be when it starts its potential direct listing.
You think we'd even be having this conversation if we hadn't had some of the high-profile blow-ups of late?
I think we would. The conversation probably started over a year ago. Spotify and Barry McCarthy, especially their CFO, has been a real leader in discussing this change. And then Slack continued the conversation. And I think a lot of companies that have gone public in the last 12 months have taken it seriously. But I now see there's a groundswell among founders, investors, and even employees who would benefit from this.
Part of this, Deirdre, is, on Bill Gurley's part, I guess, is to try and just, blow up the status quo. Tired of seeing things done the way they've been done and wanting to do something about it. And he has the capital, political, if you will, in the Valley and obviously financially to make a difference.
I think it's about two major things. I mentioned it, leverage and flexibility. I think he's trying to tell startups that you have more of a voice in this. You don't need to do what the investment bankers take the traditional route that has been done for many, many years. And I really think the turning point this year has been Slack. If it was just Spotify that had done it, it might have been a one-off. But the fact that Slack did it, and I would argue successfully, yes, when you take a look at the share price up on the screen right now, it has tumbled since that direct listing. However, remember that its valuation right now is billions. It's $12.5 billion. Its last private market valuation was $7 billion. So, you look at this and it has been a really effective way to let their employees and early investors cash out while getting them public and saving on a lot of those fees.
Yeah. Rick, you want to opine on what Deirdre said?
I think it's probably less about fees and more the discount and missing that pop. As you had Bill talk about in the previous segment, it's billions of dollars this year alone. And that's money out of the founders' pockets, employees' pockets, and other existing investors. And there's just better ways for price discovery rather than just doing it by hand manually with the lead underwriters.
The other interesting point is that, Gurley was obviously highly critical of Goldman Sachs and Morgan Stanley, specifically in the interview that we did out in San Francisco. Now I've learned that Goldman is having a conference on Wednesday in Las Vegas around innovative private companies and heavy on the docket and the agenda there, direct listings versus IPOs. So Goldman and these others are being forced to deal with this issue because it's hitting them head on.
It is, and Goldman Conference happens every year, so it's already set in stone. But I think folks are trying to, they see the groundswell and they're trying to justify what's actually going on. Part of the issue in direct listings is oftentimes when a company or an entrepreneur goes public, that's their one time interfacing with an investment bank. So the other customer the bank would have would be the institutional investors on the other side, which see the same underwriters almost weekly during IPO seasons. So it's who is the recurring customer in that structure is the other kind of interesting dynamic to watch in the business.
Hi, Rick. It's Joe. So I guess the other angle on this would be maturity. And if I think about Airbnb, I think about a company that's been around, if I'm not mistaken, at least about 10 years. The direct listing, doesn't that give an Airbnb and really a lost opportunity for Uber to kind of avoid opening some of the cultural challenges that if they have the traditional roadshow, they have to go out and they have to reveal? Airbnb has regulatory battles that if they go direct listing, they really don't have to get involved in that once again. I think Uber made that same mistake where they had a rehash history.
Well, I think you have to go through the same S1 process. So there's the same level of disclosures, the same level of disclosure of risk factors. You don't have to maybe face the institutional investors head to head to address any concerns they might have. But I always think companies are better off addressing risk factors, addressing issues which might be out there. And so I think Airbnb could avoid that with maybe large institutional investors. But many of those folks are going to sit down with regardless, and the key risk factors as part of your S1 is something you should address head on.
Lastly, Rick, before we go, should Airbnb have already gone public? They wait too long?
I don't think they waited too long. I think that business is so strong. They have increasing moats in their marketplace, And I think you'll probably see a public financing of some sort from them in the next 6 to 12 months. So I think they'll be right on schedule.
All right, we appreciate your time. Look forward to talking to you again. That's Rick Heisman, Deirdre
Thanks, guys.
Bosa
Appreciate
joining
it.
us as well. Appreciate it from you. We'll talk to you soon.